system. You're probably familiar with Xero, spelled Xero, receipt management. Yes, guys, welcome back to another episode of Car Talks. Today I want to just talk about something that I went through with a client yesterday, and that is, how much is your company really worth? You probably got to the point like me where either for my clients or for myself, it's just an interesting exercise to say, like, what would you walk away for? Would you walk away? What are you in this business for? How much is your business currently worth? And what's it going to take to get to the point which is your walk away number? So for me, I don't know, I haven't thought about this in a while, but my exit strategy is not to sell my business, primarily because I want to have an asset with recurring revenue that I can pass down to my kids should they want to come and work with me. However, it's interesting to know, what a company is worth. It's become more and more difficult to value a company because of businesses like, straighten this out a bit, businesses like Instagram, whereby what is this doing? Oh, there we go. They don't make any money. They don't trade. At that time, all they do is hold data and have a community of engaged participants, I guess, in their app. And there is inherent value in that business. Now, I'm not going to talk about those kind of businesses because ultimately they're worth what someone else is willing to pay, and how they will calculate the valuation is thinking, well, there are 100 million users. If we were to just generate X amount of advertising revenue by turning advertising on to each of those users, here's how much we could make. And that's their thought process. So that's how those companies are valued. But my ideal client, who I'm talking to here, the niches that we work with at Grow Factor don't tend to be venture-backed tech companies. That's the one niche that we kind of generally stay out of. So how are companies valued otherwise? Well, at the moment I'm running a valuation report for one of my clients who runs a chain of physios. We're going through the exit process with another client of ours who are IT consultants essentially, but they go into FTSE 100, FTSE 250 businesses and look for ways that they can make that business more efficient, therefore generate a return on investment. Once they have a project scope agreed with the client, they'll put people into that business for 1, 2, 3, 4, 6 months and bill those people for their time. And they've really good margins. They've grown significantly. And now they're going through the process of being bought by someone else. The client that I've been working with this week run a business that they have events, they run whole service marketing, do a variety of things really around event, brand building and marketing. They are looking to get out of that business, work for a period of time, which is called an earn-out, and get some money in. They're at the time in their lives where they'd like to retire, in inverted commas, spend a bit more time with the family, play golf, go on more holidays, do whatever you want to do. And actually, interestingly, recently, one of our first ever clients, who isn't a client anymore because we moved away, I moved to the Midlands, they're still in London, they wanted a local accountant, started a new business, which didn't actually make any money, but got acquired by a big group who felt that if they brought that company into their group and it would benefit from economies of scale, could make money, and so bought that for a significant sum. But let's assume that you're running a business, it's profitable, it's growing, You've been running it for X number of years, 5 to 10 years, and you want to know what it's worth. How do you value your company? Well, the way that we recommend doing valuations is using a variety of valuation methods, writing a valuation report, and coming up with an average of those methods. So, for example, we can look at a price to earnings ratio. That's one way to value a company. How much profit or EBITDA, earnings before interest, depreciation, tax, amortization. So your earnings, really equating that to cash generated. How much, what is that number? And you multiply it by whatever the industry standard is for the PE ratio. So for example, let's say the PE ratio in your industry is 10, you make £500,000 profit. It's pretty stable, it's growing every year, or it's recurring revenue. Your business would be then valued at £5 million. If you did a projection, you could discount future earnings or future cash flows. So one of the other ways to value a company is to do a discounted cash flow valuation. So project out into the future if you're growing, because it's maybe not fair to say I want to sell my business now, but actually we've got a growth rate of 30 to 50% year on year, and you're missing out on all of that growth. So do a discounted cash flow projection in a Google Sheet 3, 4, 5 years into the future. Use discounting, which you should have learned in GCSE A-level maths, to bring the value of those cash flows to the present value. And then that will give you a value of your company using a different method. Another way is the net asset value. So on your balance sheet, there's a net asset figure. If you go and have a look in Xero, run a report, look at the net asset figure. What is that number? That's another way to value the company. These are all ways to value companies, and none of them are right and none of them are wrong. These are ways to start at a number which you can then justify to any incoming purchaser is the value of your company. It's the starting point of a conversation. And what does the process look like? And there are a number of other ways you can do it. Okay, there are a couple of more ways that we put in our valuation report. And again, we look at the context of the company. Is there much competition? What are the growth rates? For example, this company maybe it only makes 500k, but they've got 1 million people in a free Facebook group. They've got an email list of 50,000 with an open rate of 40%. There are all these sort of qualitative factors which you can put alongside the quantitative stuff. What's the process though? Okay, so you need to find someone who may like to buy you. So for an accounting firm, you might go to a broker and they'd look at other accountants that are looking to buy. It might be, so in my case, I probably only sell if a top 10 firm came along, they wanted the best small accountancy firm for owner managed businesses to bring into their portfolio, and they were willing to pay a ridiculous sort of price to earnings ratio or a revenue multiple, because we've got recurring revenue. In a recurring revenue business, you can always use a revenue factor, so maybe they'll pay 3, 4, 5 times revenue. Now if I did that, and let's say my business is turning over £2 million roughly, and I had a 5 times multiple, my business is worth 10 million. Do I think I could retire on 10 million? No, because I'd probably need to go and grow that some more, but I could take the 10 million and do something else. But I don't want to do anything else. I love what I do, love working with my clients, love helping my clients. Gives me a good work-life balance, so happy where we are right now. But what's the process that you go through? Okay, first of all, find someone who may want to buy your business. Secondly, you create your own valuation of what you think the business is worth. You then go through discussions. If the figure is material enough, you will appoint someone who's a specialist in mergers and acquisitions to sit in between you, the seller, and the buyer to facilitate those negotiations. They will do what's called due diligence on your accounts. They will look at your accounts and make sure they're a true and fair reflection of your business. You then have the opportunity to add back extraordinary items. So you may be putting through things that are one-offs, or really they might be classified as expenses that are personally related to you as a director. If you weren't in the business, then You are buying those for the business, so they are deductible. But if you weren't in the business wouldn't necessarily have to incur them. You can add those back, you can disclose them, you can come up with a new profit figure, you can come up with a new valuation. What they're going to want to do is obviously drive the valuation down. So they're going to look at things like, is there any work in progress that you've billed too much for? Should you have billed less for it? Is there a journal adjustment that needs to be made as a provision to reduce profit because there's an underlying risk, like there's a court case on the horizon, or there's a client that looks like they might not pay based on their credit rating, etc. Similarly, you can accrue income if you are working on a project, you're 3 months in, you haven't invoiced it for it yet, but it's due to be invoiced. You could accrue income, which means bringing in more income to your business in order to raise revenue, and therefore that will drop through to profit. You can defer income, which is what they'd be arguing to do, to move income into a future period, because you shouldn't really be recognizing income in this period now. All these things are related to what we call accruals accounting, which is recognizing income and expenditure into the period, so month, to which it actually relates. Okay, and you should, what I'd recommend off the back of all of this is have projections and plans and have an ability to measure your progress against those plans. Build in a valuation model into your Google Sheet, which is your forecast and your budget. Then you know what your business is worth, what it will be worth in the future. Then operate what we call accruals accounting. So your bookkeeper should really be a qualified accountant. They're closing off your month end by booking accruals adjustments. So they're booking depreciation, they're booking amortization, they're moving income into the period to which it relates. They are deferring revenue, they're accruing income. They are, where are my keys? Oh no, I've done it again. I've left the keys in the house and the gate is locked. So bear with me, I'm going to go and unlock the gate with the key code. The perils of success. So if you have real-time accounting, if you have weekly bookkeeping, if you do accruals accounting, which is the opposite of cash accounting, which most small businesses do, and they don't understand the value in doing accruals accounting because it's more expensive, more time consuming for your bookkeeping. But then you get a potential purchaser come in, instead of having to go and redo all your accounting for the last 3 years, you've got everything already in place, ready to go. You know the true value of your business. You can analyze the financial performance of your business correctly, because you're not looking at a particular month and thinking, oh my God, we did amazing this month. Actually, you invoiced 150k for a 6-month project, which you've got to deliver over 6 months. So you should be spreading that over 6 months. So hopefully that's helpful, guys, just in terms of what you should do now to maximize the value of your business, how you can value your business and what it might be worth. What is the process if someone comes to acquire your business and are you looking to sell? And a bit of decision making in terms of should you be looking to sell your business or not. That's it for today. I'll think of something else for tomorrow. It's whatever I've been through. Like I said, I was on a call yesterday with the mergers and acquisition specialist, with the client, not with the buyer, with the accountants of the buyer, who are scrutinizing all of our records. We've been doing bookkeeping and accounting for this client and tax planning for the last 5 years. They found one question in doing all of their due diligence. What were the policies and the procedures for you to be deferring revenue at the year end? To which we answered. Everything else they were happy with. And that is the benefit of having a quality accountant. You don't open a can of worms and scare off any potential purchaser because your accounts are in such a mess. So see you in the next one, guys. Have a great day wherever you are, whatever you're doing. Be consistent, be committed, be confident.